Anyone interested in the hard recovery of the Chinese economy needs to know how much economic firepower the government has. But the real amount of China's debt makes the answer to that question very important. For a country that has grown so much through investment, China's government seems to have a very reasonable amount of debt. According to the government, general government debt, which includes both national and local government debt, is about 55% of GDP. This is about the same as other countries in the Asia-Pacific region, like Australia and Korea, which have much higher GDP per capita. This means that Beijing has a lot of extra money to help the many areas that are having trouble paying their debts. In November of last year, officials said they would issue $140 billion in special government bonds to help local governments. This caused the 2023 budget deficit to rise by 0.8% to 3.8%. But for a country like China, that's a very small amount of money. Many investors are confused about the government's lackluster efforts to help the economy, which is having a hard time. A slightly better way to understand China's fiscal conservatism is to look at the larger general government debt, which includes funds linked to the government. That number is expected to be close to 70% of GDP by the end of 2023. China is more vulnerable than other emerging markets with lower ratings, like Indonesia and the Philippines, and more like its peers, like India. But that number doesn't even begin to show how big the risks are with local government financing vehicles, or LGFVs. During the decades of China's debt-fueled growth, these shadow financing tools helped the provinces do well. They made it possible to build impressive roads and trains while keeping the government's debts off of its books. But they counted on selling land, and when the real estate market crashed in 2021, things started to fall apart. LGFVs can't be totally ignored when investors look at the government's debt, which is worth RMB 60 TN. Even though we think it's very unlikely that all LGFV debt would have to be recognized as a liability of the central government, when it is, China's government debt ratio rises to about 130%, which is higher than most emerging markets, and about the same as developed markets that used quantitative easing, like France and Italy in the Eurozone, the UK, the US, and Canada. LGFVs won't be the only ones looking for help if growth slows down even more. China's gross national debt is more than 300% of its GDP as a whole. A lot of debt limits the government's ability to use its money to help people. This means it can't do bigger aid programs, and its support measures aren't as effective. Why a central government with a debt that seems manageable is using extend and pretend tactics to buy time. Beijing told local governments to start an RMB 1.5 TN debt swap. It will only cover half of the average interest cost of LGFV debt that is still outstanding. But the extra bonds will help increase liquidity and, most importantly, investor trust. Also, banks have been told to do national service by refinancing LGFV loans. Local news outlets say that an infrastructure LGFV in Zunyi, a rural city in Guizhou province that isn't very wealthy, got a 20-year extension on its LGFV's debt and will only have to pay interest for the first 10 years. Because the government knew the debt problem had to be fixed quickly, it sped up spending that had already been passed last year. For example, it issued some of the RMB 4.3 TN in local government bonds early. By 2023, when about RMB 1.14 in refinancing bonds were issued as well, the overall amount of local government bonds issued reached 4.5% of GDP for the year. As new money comes in, it's likely to go to strategic national goals, like high-end manufacturing and infrastructure projects that can be funded by businesses. Over the past 10 years, China's debt has gone through the roof. This is mostly because of more loans given to state-owned businesses after the global financial crisis. Some people think that China's huge debt is a threat to its security and maybe even to the world economy as a whole. Others think that these worries are overblown because most of China's debt is owned by the government and can be handled. But how did China go from being the invincible force behind global economic growth to being seen by many as a debt-time bomb that could send shockwaves through the world's financial system if its credit bubble bursts? The answer is pretty easy to understand. Another thing that makes China unique is how quickly its debt has grown compared to the size of its economy. Debt has grown much more slowly in places like the US and even Japan, which has a lot of debt. China, on the other hand, has a lot more debt compared to its economy than it did before the global financial crisis 15 years ago. This makes it much harder to handle. China lends less than 6% of its yearly economic output to developing countries, which is a small amount compared to its own debt. However, these loans are politically sensitive. Even though Chinese social media is heavily censored, complaints do appear from time to time. Some people say that banks should have given the money to struggling families and areas in China instead of sending it abroad. People in the country are very against the idea of taking big losses on these foreign loans. Some people may play down the risks, but China's debt problem is much more complicated and dangerous than it seems at first glance. China's debt is scary, and not just because of the amount. It's also scary because companies are getting money so quickly. The ratio of non-financial sector debt to GDP has gone through the roof since 2008. This is because the government has been taking steps to boost economic growth. Cheap credit has been good for businesses, especially state-owned companies, SOEs. These SOEs hold about 2/3 of corporate debt as of 2023, but many of them are still losing money and not working as well as they could. It was found that by 2023, China's business debt had grown to almost 160% of GDP. This increase is especially scary because more than half of this debt is held by SOEs, which are known for being inefficient and not making much money. Even though the government is trying to make things better, the load is getting heavier. The stress is clear when you look at how well Chinese businesses are doing financially. The number of companies with a good net debt to EBITDA ratio between 0 and 5 has dropped by almost 32% since 2008. At the same time, there are a lot more companies that are either losing money or have a dangerous ratio above 5. The effects of this are very important. When a company's debt grows and its earnings stay the same, the risk of failure goes up, even more so for local governments whose bills are equal to about 30% of China's GDP. It goes up to 40–50% of national output when the bills of their financing units are added in. Some debts are moved between government groups, so there is also a chance of double counting. To make things even more complicated, Chinese businesses are having a harder time keeping up with their debt payments as their earnings stay the same. Many of these companies are having a harder time paying their bills because the global economy is slowing down and growth in the United States is being slowed down. This is a big problem for the world economy as a whole, not just China. A wave of business defaults could send shockwaves around the world. For LGFVs to work best, they should look more like businesses. The winners would think like managers to lower debt, while the losers would be left to fail. Money and capital would be sent back to businesses that make things. To get supply and demand back in balance, the housing market should fix itself, even if it means losing money and the real estate business merging. Home prices going down means that people's net worth is going down too. This is painful for them, but they may end up with a more balanced asset mix that includes more stocks and bonds. But because of a lot of debt and slow demand, China isn't as interested in market-driven changes for LGFVs as it is in getting them to quickly stabilize their finances. The most important thing for China right now is still safeguarding against systemic risks. This is different from the last big debt problem in the 1990s, when the country was just starting to open up to the world and reform. The government worked even harder to get rid of bad debt and privatize state-owned businesses. Short term, when policy changed to be more flexible, changes to policy are also changing the way buyers see the government bond market as a whole. The recent promise by China's leaders to keep liquidity reasonable and adequate and financing costs constantly decreasing means that long-term rates will go down, which will make investing in bonds more appealing in the medium term. Even though it seems counterintuitive, China's debt market, which has caused buyers a lot of worry, could also be where they find valuable assets. Back in 2010, only 5% of China's loans to other countries went to people who were having trouble paying their bills. After some time, that number has grown to 60%, according to Bradley Parks, who is in charge of aid data at William & Mary, a college in Williamsburg, Virginia. China lends the most money to developing countries than any other country, but Western hedge funds have also bought a lot of loans from these countries. The interest rates on these bonds are usually set, but when China's banks lend dollars, the rates are usually tied to interest rates in the West. When the Federal Reserve raised rates by a large amount, developing countries' loan payments to China have gone through the roof. Many of the world's poorest governments will continue to spend a big chunk of their budgets on paying off debt if nothing is done to lower it. This is money that could be used to build schools, clinics, and other important services. Parks said, "The biggest losers will be regular people in the developing world who can't get basic public services because their governments have too much debt to pay off." Chinese people have a lot of debt, and there aren't any easy solutions in sight. The country needs to stop relying so much on government building projects that are financed by debt and huge spending on national security. Instead, we should slowly move toward an economy that is powered by services. There are strong groups in Beijing and many provincial cities that want to keep things the same when it comes to the economy. 21 banks in China agreed to let a local government financial unit in southwestern China pay back its loan over 20 years instead of 10 years. Another thing they let the unit do was pay only interest for the first 10 years, not the capital. Even though this gave the local government some breathing room, the banks lost a lot of money. What's even worse is that almost every province in China has local finance units that are having the same bad luck. But the problems don't end when you leave China. Is that China could be about to go through a crisis, like other countries that had their debts grow quickly and then had a financial crash. Some people are really scared about this similarity. On the other hand, some experts say China probably won't have a hard landing. This is why they save a lot of money and the government owns most of their debt. China doesn't owe much money to other countries. Simply put, banks that are controlled by the government give money to businesses that are also controlled by the government. This means that the government has a lot of power over the situation. This might make it easier for China to handle its debt and keep the economy from going into a terrible depression. What does this all mean? There is no question that China has a hard road ahead of them. There are real risks, but the country's unique economic system gives it some tools to get through these rough times. The most important thing will be whether China can change the direction of its economy without causing a financial crisis. The world is paying close attention because there is a lot at stake. With all that said, China's debt position is like a balancing act that needs smart moves and choices. If the country can figure out how to match its current economic goals with the need for change, it might be able to avoid the problems that other countries have had. That being said, if they don't, it could have big effects on the world economy as well as China. There are many steps to take, and the story is far from over. If you made it this far, be sure to watch more movies on the channel. So please tell us what you think the future holds for China in the area below for comments.